Chinese investors want to own more real estate in the U.S. and Europe. U.S. investors want to own the right real estate in China. Tim Walsh is the former CIO for New Jersey State's pension fund. He is now the head of the U.S. office of GAW Capital Partners. We talked about, well, just the trace of money going back and forth.
If you're a teacher's pension fund in Korea or a teacher's pension fund in Kentucky, you have one thing in common: you got to be diversified. And I think that's a global trend. It's been going on, but it's continuing as a trend. It's continuing in real estate too. U.S. investors, in my opinion, are underinvested in Asia, and Asian investors are woefully underinvested in real estate around the world.
So how do you reassure your clients that the deals are safe?
I think it's based on performance. We just closed our fourth fund in China right now, or very close to closing it. We raised over $1 billion, and very diverse investor base: United States investors, Asian investors, European investors. It's the fourth fund too. They've actually done incredibly well, very opportunistic. In a very smart group.
U.S. institutional money, there's about 6 to 8% in real estate.
The average asset allocation. I think U.S. public pension funds, for instance, which I came from, New Jersey was a little bit lower than that, but I think the average was somewhere around 7%.
And you're saying that in Asia, if you look at the counterparties, their institutional money, it's less than 2%.
On 1.7%, yeah, significantly lower. And Europeans actually have also had historically more exposure to real estate as well.
So that implies that as Asia grows, there are going to be more and more Asian investors looking for real estate deals here in the U.S.
I believe so. In Europe as well. They've actually been, there's been some publicity here in the last year or so about Chinese investors buying in New York City. But if you look at it, they've actually been focusing a lot more in Europe. I think eventually as time comes on, they'll be focusing more.
Is that just because Europe is cheaper right now?
I think it's cheaper, liquid. I mean, the London market is like the Hong Kong and New York City markets. They're very liquid. You can actually do a transaction very quickly, scale, good leases. You know, the UK government, the UK country's been around for a long time. It's sort of considered a safe investment area, just like New York City, United States.
One statistic that you gave me is that Asian office space is the only asset class right now out there anywhere in the world that is actually higher than the peak. And when we talk about peak, we talk pre-credit crisis, so 2006, early 2007.
The only one.
So what does that say about the future capital flows?
Well, for U.S. investors, for instance, they haven't had much exposure to it. You know, we look at two things. They look at diversification, and they look at risk-adjusted returns. So you actually would have done better in, you know, the overseas, the China real estate market, for instance, or the Singapore real estate market than you would have done here in the United States since the crisis. I think 2007 was the peak.
So there are then U.S. investors who feel like we should have been on this 5 years ago, but better late than never.
Well,
so would like
exactly.
To get in.
And some have been there. You know, we've had GAW's had investors, I think, since pre-crisis, U.S. investors. But if you look at U.S. investors as a whole, in my opinion, they're sort of underallocated to Asian real estate, and you have Asian real estate institutions that are underallocated to the United States.
What are the questions you get all the time about investing in real estate in Asia?
In Asia, it's, you know, how it works. It's just different from the United States. So you could actually buy a building here in downtown New York City in a quick fashion in maybe 6 weeks. Due diligence, et cetera, financing, optimistically. In China, in Asia, it takes a lot longer. You know, 6 months is not a atypical time to actually complete a transaction. Sometimes longer. It's just a different process. If Asian institutions start increasing their exposure from 1.7% to 2.5%, somewhere around there, over the next 5 years, that's about $150 billion in equity that'll go into the global real estate market. You know, where it ends up being parked, whether it's the United States or Asia or Europe, who knows. But that's $150 billion in equity, and obviously, you know, when you put equity into a building or into an industrial piece of property, you usually leverage that up X amount of time. So take $150 billion times a multiple of 3, or et cetera, you're talking a substantial amount of money that's probably going to be coming from overseas to various parts of real estate around the world.